The cryptocurrency market is known for its wild rides. It's a place where fortunes can be made and lost in the blink of an eye. One moment, you're on top of the world, watching your investments skyrocket. The next, you're plummeting back to reality as prices take a nosedive. Prices soar to unimaginable heights, only to plummet back down to earth. This roller coaster of emotions is what draws many to the crypto market, but it's also what makes it so risky. This is the nature of this young and volatile market. Unlike traditional financial markets, cryptocurrencies are still in their infancy, and their value can be influenced by a myriad of factors, from regulatory news to social media trends. Recently, we witnessed another dramatic chapter in the crypto saga. A single tweet or a piece of news can send shockwaves through the market, causing massive price swings. In a single day, over $287 million vanished into thin air. This wasn't just a minor blip, it was a significant event that left many traders reeling. This event, known as a liquidation, sent shockwaves through the crypto community. Liquidations occur when traders are forced to sell their assets to cover losses, often leading to a cascade of selling that drives prices even lower. Let's break down what happened and what it means for the future of digital currencies. Understanding these events is crucial for anyone looking to navigate the turbulent waters of the crypto market. Our journey takes us through the interconnected world of Bitcoin, XRP, and Dogecoin. Each of these digital currencies has its own story, its own community, and its own set of challenges and opportunities. Fasten your seatbelts, it's going to be a bumpy ride. The world of cryptocurrency is not for the faint of heart, but for those who can handle the ups and downs. It offers a thrilling adventure. To understand this sudden crash, we need to rewind the clock. January 2025 saw Bitcoin, the king of cryptocurrencies, reach a record-breaking price of $108,786. This surge was fueled by a wave of optimism. Institutional investors were jumping in, and the future seemed bright. However, as we often see in the cosmos, what goes up must come down. The market, perhaps drunk on its own success, experienced a sharp correction. Bitcoin's price fell, and the dominoes began to fall. The crypto market is interconnected. When one major player stumbles, others often follow. This time, XRP and Dogecoin felt the heat. XRP, the cryptocurrency associated with Ripple Labs, dropped by 3.78%. Dogecoin, the meme-based coin that took the internet by storm, tumbled by 4.2%. Even Bitcoin, despite its size and dominance, wasn't immune, experiencing a 2% decline. These may seem like small percentages in the grand scheme of the cosmos, but in the volatile world of crypto, they represent significant sums of money lost. At the heart of this crypto chaos lies a term that strikes fear into the hearts of traders: liquidation. It's a word that can send shivers down the spine of even the most seasoned investors. But what exactly does it mean, and why is it so dreaded? Imagine a contract where you bet on the future price of a cryptocurrency. This is known as a futures contract, a popular tool in the trading world. Traders use these contracts to speculate on the price movements of various cryptocurrencies, hoping to profit from their predictions. This is a futures contract. It allows traders to lock in a price for a future date, providing a way to hedge against price volatility. However, it also comes with significant risks. Now imagine adding leverage, like borrowing money to make a bigger bet. Leverage amplifies both potential gains and potential losses, making it a double-edged sword. Traders often use leverage to increase their exposure to the market without needing to invest a large amount of capital up front. This is where perpetual futures come into play. Unlike traditional futures contracts, perpetual futures have no set expiry date. This means traders can hold their positions for as long as they want, provided they meet the margin requirements. These contracts have no expiry date, allowing traders to hold their positions indefinitely. But there's a catch. The longer you hold a leveraged position, the more you are exposed to market fluctuations, which can be both an opportunity and a risk. If the market moves against you and your losses exceed a certain threshold, your position is automatically closed to prevent further losses. This automatic closure is a safety mechanism designed to protect both the trader and the exchange from excessive losses. This forced closure is called a liquidation. It occurs when the margin balance falls below the maintenance margin requirement. Understanding liquidation is crucial for anyone involved in leveraged trading, as it can mean the difference between a calculated risk and a catastrophic loss. While the liquidation event sent ripples through the crypto market, other forces were at play. Whales, individuals or entities holding massive amounts of Bitcoin were making their presence known. Data showed a record number of wallets holding between 100 and 1,000 Bitcoin. This suggests that big players were accumulating Bitcoin even as the market experienced turbulence. Meanwhile, the world of traditional finance was also dipping its toes into the crypto waters. Bitcoin ETFs, exchange-traded funds that track the price of Bitcoin, attracted significant inflows. This indicates growing institutional interest in Bitcoin as an asset class. Section 6, XRP, a case study in overconfidence. The XRP liquidation event revealed a stark imbalance in market sentiment. An overwhelming 97% of liquidated XRP positions were long positions. This means that traders had bet on the price of XRP going up. When the price dipped even slightly, their leveraged positions were wiped out. This imbalance suggests that XRP traders were overly bullish, perhaps driven by momentum rather than sound analysis. It serves as a cautionary tale about the dangers of following the crowd in a volatile market. Section 7. Riding the waves of market sentiment. The cryptocurrency market is driven by sentiment, often more so than traditional markets. News headlines, social media trends, and even celebrity endorsements can send prices soaring or plummeting. The recent liquidation event highlights the importance of understanding market psychology. When fear and panic grip the market, as they did during the liquidation, rational decision-making can go out the window. It's essential to stay informed, manage risk carefully, and avoid making impulsive trades based on fleeting emotions. Section 8. The future of crypto volatility and opportunity. The $287 million liquidation event, while significant, is but a blip on the radar of the long-term cryptocurrency journey. Such events, while dramatic, are not uncommon in the world of digital currencies. They serve as stark reminders of the market's inherent volatility and the risks involved in trading these assets. Yet for many investors, these fluctuations are part of the allure, offering opportunities for substantial gains if navigated wisely. Volatility is inherent in this market. Prices can swing wildly within a matter of hours, driven by factors ranging from regulatory news to technological advancements and market sentiment. This unpredictability can be daunting for newcomers, but is also what makes the market so dynamic and exciting. Experienced traders often thrive in such environments, leveraging their knowledge and strategies to capitalize on the rapid changes. It's a double-edged sword, capable of generating both exhilarating profits and devastating losses. The emotional rollercoaster that traders experience is intense, with moments of euphoria often followed by periods of anxiety. Managing these emotions is crucial for long-term success in the crypto market. Traders must remain disciplined, sticking to their strategies and not letting fear or greed dictate their decisions. As with any emerging technology, there will be bumps along the way. The path to widespread adoption is rarely smooth, and the cryptocurrency market is no exception. Regulatory challenges, technological hurdles, and market skepticism are just a few of the obstacles that must be overcome. However, each challenge also presents an opportunity for growth and improvement, driving the industry forward. However, the underlying technology of blockchain and the potential for decentralized finance continue to drive innovation and attract investment. Blockchain's promise of transparency, security, and decentralization is revolutionizing various industries, from finance to supply chain management. Decentralized finance, or DeFi, is opening up new avenues for financial inclusion, allowing individuals to access financial services without traditional intermediaries. The future of crypto is uncertain, but one thing is clear: it will continue to be a wild ride. As the market evolves, new opportunities and challenges will emerge, shaping the landscape in unpredictable ways. Investors and enthusiasts alike must stay informed and adaptable, ready to navigate the twists and turns of this ever-changing market. The journey may be tumultuous, but for those who are prepared, the rewards can be substantial. Section 9. A final word: proceed with caution. The cryptocurrency market is not for the faint of heart. It's a realm of high risk and high reward. Before diving in, it's crucial to understand the technology, the risks involved, and the importance of responsible trading. Remember, never invest more than you can afford to lose. Approach the crypto market with a sense of wonder, a healthy dose of skepticism, and a commitment to continuous learning. The universe of cryptocurrency is vast and ever-expanding. Explore it wisely, and who knows what wonders you might discover. Be sure to like, share, and subscribe. Thanks for watching.